Well, this week's Offshore Investment is all about Warren Buffett's annual letter to shareholders. The chairman and CEO of Berkshire Hathaway stirred up quite a bit of interest with his letter. He always does. His critics are mounting, as he did admit to overpaying for Kraft on the whole Kraft Heinz miss. But one could equally argue that the legacy brands companies are suffering a structural decline that was quite hard to predict 5 or so years ago. Anyway, the Oracle of Omaha also said in his annual shareholder letter that he's abandoning his long-time metric for valuing his conglomerate shares, the price-to-book value. Well, we've got Dr Adrian Saville, Chief Executive of Cannon Asset Managers, on the line to talk about the latest musings from the Oracle of Omaha. Adrian, great to chat to you again.
Great being with you. Thanks for having me on the show.
Now, he certainly would have advocated for our lottery winners' approach to his winnings and taking his time, not being in a rush. But I want to talk about price to book. Why is price to book no longer useful, according to Buffett?
There's at least two reasons. The one is accounting conventions, which have changed in recent times and oblige you to recognize especially changes in intangibles. And if you put those through the book, it creates moving parts which you must either write up or write down, and makes not only interpretation but analysis, that much more complicated. I think the other aspect, of price to book, putting aside the accounting conventions, is that if you just look at the nature of the portfolio, it has disconnected in terms of the reported value and the accounting value. That there's a very large disconnect, and you've got, I guess you've got a temperature gauge that isn't quite working the way it should. It doesn't have the precision and the accuracy that it could. And so his reporting on book value might be him accounting for himself on how he's doing, but it doesn't seem like the market is recognizing this, and certainly the accounting profession.
Well, he had a go. He had a go at GARP in this letter. But if you look at it, a staggering net loss of $25 billion in the fourth quarter, the biggest in its history. But it's largely due to a new accounting rule, and Buffett and Munger disagree with it. It does cause wild swings and gyrations in the bottom line.
Look, it does cause swings and gyrations in your balance sheet value. I wouldn't be distracted from. I wouldn't let that distract us from the operating performance of the business. And make no mistake, Kraft Heinz is struggling. It hasn't achieved what was anticipated in putting the two businesses together, and the primary strategy of putting those two businesses together was essentially a cost-cutting and synergistic approach, a business school classroom approach. That was the big idea, and no sooner had they come together, they quickly went after Unilever to form an even bigger portfolio. And I guess, with a little bit of hindsight, you have to say, thankfully for all three of them, they weren't successful in that, because they are struggling with their portfolio. And, this is where I think Buffett really has distinguished himself in buying businesses. Is the reason why he has, with the benefit of hindsight, paid such good prices for businesses is they have shone through in terms of their defensive attributes, what he refers to as moats, their ability to protect their competitive advantages. And it seems like Kraft and Heinz have misstepped in terms of this ability to defend its moat and defend their competitive advantage.
With the benefit of hindsight, we might say there, Adrian, but he is very quick to admit he overpaid, and he took that one on the chin. But reading through the letter, he loves his tree analogies, and he wants and implores investors to focus on the forest and forget the individual trees. And there is method to taking that sort of holistic approach to portfolio construction.
There's a powerful message in portfolio construction that there is no investor who will get to the end result without having some impressive mistakes to report back on. That's part of investing. It's part and parcel of the industry. And the portfolio that he has built over many decades has this strong attribute of businesses that have earnings engines inside of them. They are worth generally more next year than they are worth this year, even if the market doesn't recognize it year on year. Eventually, that earnings power will shine through. The earnings power can be defended by this attribute of moats. He loves dividends. He loves accumulating cash. I think each of these is a very clear message or lesson principle in successful investing.
Is there one thing that stood out for you? I mean, there was so much to go through tonight. We could fill a 90-minute show going through some of the nuggets and debating it. But is there one thing that really shone out for you, Adrian?
The beauty of these letters is you can read them many years after the fact, and they are still filled with gems. I think, and I'm going to draw on your forest for the trees analogy, is Buffett's looking for a big acquisition. They need something that's a needle mover. And I think that big acquisition is sitting right in front of them. And it's their own business. One of the most powerful ways to do successful M&A is if you've got a great business, if it's trading at less than its book value, why don't you buy it and cancel those shares? And you've got an even more valuable business. So it seems to be that they're after making sure that Berkshire gets bigger. And to me, that isn't a real attribute of successful investing. You want it to get better, and then it will get bigger. And so I would venture that the most obvious acquisition for them is right in front of them. It's not some giant animal out there, be that Apple or any other animal that you want to point to in the capital markets.
Maybe like that 1,200-year-old baobab out in Limpopo. They are perhaps pursuing size at the risk of not seeing what's right in front of them. Dr. Adrian Saville, Chief Investment or Chief Executive, I should say, of Gannon Asset Managers, also Chief Investment Guru here on Classic Business, talking about the latest pearls of wisdom from the Oracle of Omaha.